In the first 3.5 months of 2024, SoundHound AI stock skyrocketed 4.2x to a 52-week high of $8.91, only to lose 54% since then. The stock is still up 95% year to date, but does it still have room to run, or is it ready for another crash? Let's dive in and find out. All right, quick shout out to your man Zach, William Trice, and Klaus Boom for suggesting this week's company. 3 points that we are going to cover in this video. Number one, business model company updates. So SoundHound has done a massive cleanup of their balance sheet since the end of 1Q24, which I will get into because it's not reflected in the financials. Also, SoundHound uses proprietary AI technology that lets businesses offer conversational experience to customers across multiple languages in multiple industries, including automotive, TV, and customer service. Think of a Siri or Alexa on steroids and speed. Number two, the opportunity, positives and negatives. This is one of the most volatile stocks out there with a beta of 3, one of the highest I have ever seen. But with a cleaned up balance sheet, massive growth, and a famous investor buying over 1 million shares recently, will we see the company on the right track or not? Lastly, number 3, the valuation. On Wall Street, we build 3-statement financial models culminating in a DCF valuation. I have built a 3-statement model for SoundHound, and I can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. Part 1, business model. So in April 2022, SoundHound became a public company after merging with a SPAC, which is called a special purpose acquisition company. A SPAC is basically a shell company. There's no actual business. It does an IPO, uses the proceeds of the IPO to make an acquisition. It has to do so within a specified time frame, typically 24 months. And if they don't make the acquisition, they have to give the money back to the shareholders. SoundHound uses proprietary technology with AI capabilities to understand speech and interpret meaning, just like a human brain. It allows businesses to create their own branded voice experiences. Customers are understood instantaneously. It's speech understanding at the speed of thought. The SoundHound developer platform called Houndify is an open access platform that allows developers to leverage SoundHound's voice AI technology and a library of over 100 content domains, such as points of interest, weather, flight status, sports, and more. Houndify's collective AI is an architecture for connecting domain knowledge that encourages collaboration and contribution among developers and is always learning. It's also greater than the sum of its parts, ensuring the platform continues to become smarter at a faster rate. SoundHound's technology is in live production and at scale with companies around the globe, including Hyundai, Mercedes-Benz, Pandora, Snap, Vizio, Kia, and Stellantis. So the strategy that the company articulates, we believe that voice AI will be the next major technology disruption in computing. The company vision, create a voice AI platform that exceeds human capabilities and brings value and delight via an ecosystem of billions of products enhanced by innovation and monetization opportunities. Now, according to Juniper Research, the market opportunity for voice AI transactions will exceed 160 billion by 2026, enabled by a growing need for voice AI in many industries, including automotive, restaurants, smart TVs, retail, and hospitality, as well as customer service. Now, while this all sounds good and well, I know what you're thinking. So, Ken, how exactly do they make money? The company has 3 revenue pillars. Number 1, products. These are voice-enabled products across automotive and consumer electronics. Those generate royalties. This involves voice-enabling a product. The product creator pays SoundHound a royalty based on volume, usage, or duration. SoundHound collects royalties when Houndify is integrated into a product such as a car, smart speaker, or an appliance. Number 2, services. Customer service, food ordering, content, appointments, and purchasing opportunities. This will lead to subscription revenue. This involves voice enabling a service that doesn't rely on a physical product. Examples include when SoundHound enables a customer service or food ordering for restaurants or content management, appointments, or voice commerce. It generates subscription revenue from the service providers. Lastly, number 3, ads and commerce. So this is revenue from users of products, which is pillar 1, accessing services, pillar 2. This leads to monetization. So SoundHound generates monetization revenue for generating leads and transactions and will share revenue with product creators. All right, if that word salad has you confused, let's go through an example. So a driver asked their Houndify-enabled car what restaurants are on the way home. The car can then respond with options, including restaurants that are also on the Houndify platform. These restaurants can accept orders directly from the car, and the user can order using their voice.
I'll have a classic cheeseburger with Swiss cheese, mustard, lettuce, avocado and a fried egg.
They could also customize it too. No pickles on the burger. The restaurant will pay SoundHound for that order, and SoundHound will share that revenue with the car manufacturer. In this example, each party receives value in the ecosystem. This is literally a win-win-win. The restaurant gets value because they generated a new lead and booked a sale. The driver gets value because they have placed an order just by speaking to their car. And finally, the car manufacturer delivered value to that end user and generated additional revenue from the usage of their product. Company updates. There were 3 major events that occurred after the 3/31/24 filing. On April 9th, the company announced an equity shelf offering of $150 million, which means that they can issue equity as needed at any time up to $150 million. This is not reflected in the balance sheet because they haven't issued this equity yet, but it gives a major financial flexibility to grow and invest. May 9th, the company released 1Q24 results and provided 2024 full-year revenue guidance of $65 to $77 million. June 7th, debt has gone to zero. The company prepaid a $100 million term loan. And then most recently, June 24th, preferred stock is now zero. The company converted its mandatorily redeemable convertible preferred stock, say that 5 times fast, into 2.1 million shares, which is only 0.65% of the shares out and saves the company about 1.4 million per year in preferred dividends. The company has 180 million of cash on hand, which is huge because it gives them plenty of dry powder. All right, part number 2, the opportunity, positives and negatives. I like bad news first, so let's rock and roll. Short interest, 70.6 million shares out of the 331 million shares outstanding are short, which means 21.3% of the shares are short. That's pretty significant. The last insider purchase was in May of 2022 at $4.80. Now, all through the rest of 2022, 2023, and 2024, insiders have sold a total of 3.7 million shares for a total of $12.6 million at an average price of $3.43, higher than the current close. Now, these sales have ranged from a low of 99 cents to a high of 9.55. And then, unfortunately, on June 20th, literally all the C-level executives together sold a total of 280,000 shares at an average price of $4, which again is below the current share price. There's no sugarcoating this. This is a massive red flag and not something that I'm happy about. Next, the company does not have a long track record as a public company. It is in a supernormal growth phase, which makes it very difficult to project the financials because we do not know the steady state growth rate and when it will be achieved. We've seen this previously with companies like NVIDIA as well as SoFi Technologies. The company has negative EBITDA, operating income, and net income. And our model doesn't show it turning positive for 4 more years, not until 2028. Lastly, the stock has massive volatility. Okay, all-time high close of $14.98 on May 5th, 2022. That was 6 days after going public. 7 months later, it hit an all-time low close of 97 cents. The stock then bounced between $1 and $5 in 2023, ending the year at $2.12. It closed at $8.91 on March 15th of 2024 after news of the partnership with NVIDIA, only to get cut in half since. So basically, this is the stock market equivalent of a roller coaster. All right, now the positives. So the company is in a rapid growth phase of business. The stock is really taking a beating, so it might provide a good entry point. We're going to see this next in the valuation. With over 155 patents and over 115 patents pending, spanning multiple fields, including speech recognition, natural language understanding, machine learning, this provides a technical barrier to entry in the voice AI space and discourages new entrants. Now, this one is awesome. Seth Klarman, world-famous value investor, founder, CEO, and portfolio manager of Baupost Group, recently initiated a position in SoundHound AI to the tune of 1.1 million shares at a current market value of $4.7 million. Now, just to give you some background, since 1983, Klarman is rumored to have generated returns north of 20%. That's for over 40 years. That is Warren Buffett territory. So this is a huge positive. Also, as mentioned earlier, the company has zero debt, 180 million of cash, and 150 million available to issue via equity. This means they effectively have $330 million of dry powder. SoundHound partnered with NVIDIA to deliver in-vehicle, voice-enabled generative AI responses that don't require connectivity with large language models running on NVIDIA Drive. Also, on February 14th, NVIDIA first announced a stake in SoundHound of 1.7 million shares, and that stake remained intact in the next filing on May 15th. The value of this stake is $7.2 million, and that's a significant endorsement. Lastly, acquisitions. The company closed the acquisition of Sync3 in the quarter. The combination creates the largest voice AI provider for restaurants with over 10,000 active locations. So this adds to an impressive customer list for SoundHound that includes White Castle, Jersey Mike's, Chipotle, and Applebee's. All right, part number 3, the moment we've all been waiting for, the valuation. We only have 3 years of financials, so building a projections model and DCF off of limited data is extremely challenging. If you think of a jigsaw puzzle, what do? You first grab the border pieces, build that out. That's basically the foundation, like the historical financials where we get trends. After that, you look at the box for the picture, you see what it will become. This is like the future projected financials. So in the case of SoundHound, we are building a 1,000-piece jigsaw puzzle with no border pieces and no picture. So we're basically putting pieces together one by one. That's basically what we're doing here. All right, the balance sheet. So as mentioned earlier, SoundHound has had major changes to its balance sheet since the quarterly filing on March 31st. I had to adjust the 2023 balance sheet and create a pro forma to account for these changes. Now, pro tip. When you look at a company's financials filed every quarter, 10Q, or every year, 10K, always double check to see if any events or changes have occurred after the filing. This is going to be captured in what's called an 8K, which is a filing for a material unscheduled event. Debt and preferred stock have both gone to zero. This means that they don't pay interest or dividends. We're going to see this next in the income statement. And the company announced an equity shelf offering of $150 million and a cash balance of $180 million. So what's the takeaway? SoundHound has a clean balance sheet with zero debt, $180 million of cash, and up to $150 million of equity. So over $300 million of dry powder, which shows they're on the right track. Let's hop in the model. All right, balance sheet. So a few things I want to mention here. 2023PF stands for pro forma. So this is not going to match the 2023 financials. These are the adjusted financials after the changes from the 1Q all the way to today. So as I mentioned, $180 million of cash. This is huge. Zero of debt. Zero of preferred stock. This is an incredibly clean balance sheet for a company at their stage. Okay, next we have the income statement. So revenue has grown 2.2x in 2 years for a 47% annual top line growth. In the 1Q24 results release on May 9th, management provided revenue guidance of $65 to $77 million for 2024. Now that's a very wide range of 42 to 68% growth. Gross margin, which is an indicator of profitability relative to the cost of sales, has increased from 71% in 2021 to 76% in 2023. This shows that revenue growth is significantly outpacing the growth in costs needed to generate those revenues. Next, EBITDA has been negative, and it doesn't turn positive on our model until 2028. This is a major risk factor and must be considered. This is mainly due to research and development, which has averaged about $60 million per year over the last 3 years. Now, something else to note, net income is also negative, and we're going to see this next in the cash flow statement. So what's the takeaway? Top line revenue growth is solid. Gross margin is expanding, but the company must be careful not to overdo R&D and should balance investment in the company with achieving profitability. Let's hop in the model. All right, as mentioned, 2.2x increase in top line revenue, tremendous. But again, major warning here, if you look at R&D, it's actually higher than revenue. This isn't good. Now, it's understandable for a young tech company, but it's not something we want to see persist. Therefore, EBITDA is negative, doesn't turn positive until 2028. Also, something to note, preferred dividends are going to go to zero because they converted that preferred. So that's no longer an issue for us. All right, next we have the cash flow statement. As I just mentioned, in the income statement, net income is negative, averaging negative $95 million per year over the last 3 years. Along with negative net income, the company obviously has negative operating cash flow, averaging negative $76 million per year over the last 3 years. Now, the good news is this is not a CapEx intensive business because technology produces a service rather than a physical product. Equity issuance has averaged $94 million over the last 2 years, which dilutes the existing shareholders and is not an ideal way to fund a business. The company has a cash burn rate, operating plus investing cash flow, of $68 million, so negative $68 million in 2023, which equates to 2.6 years or 31 and a half months based on cash on hand, and 4.9 years or 58 months if we include the equity shelf registration of $150 million. So when companies are in trouble or potentially going into bankruptcy or insolvency, we look at something called a cash burn rate to see how much cash they have available, how much funding they have available to survive. Lastly, the company is projected to generate positive cash beginning in 2027, which means they might have to issue some of that $150 million of equity if they don't decrease that cash burn. So what's the takeaway? While the company has positive momentum, generating positive cash flow in 2027 and positive net income in 2028 leaves investors with significant risk and uncertainty over the next 3 years. Okay, cash flow statement. As we mentioned, we have negative net income, average of 95 million negative over the last 3 years, which is going to lead to negative operating cash flow. What we also see as equity issuance averages 94 million over the last couple of years. You don't want to equity finance a company for the long term because ultimately that's going to dilute the existing shareholders. Now, silver lining, we end up seeing that we get positive net cash in 2027 as well as 2028. So it's really the next few years that are going to be absolutely critical for SoundHound. Next, we have forecast drivers and DCF assumptions. So the base case was run at the midpoint of management guidance and equates to a 55% top line growth. Cost of goods sold and sales and marketing are decreasing as a percentage of revenues, but R&D needs to be reined in. While the company has no debt, the previous debt paid off was at a rate of 14.25%. This is almost like using a credit card to finance a business, and it's really good that they paid this off. Next, they have an extremely high beta of 3. This is indicative of a very risky company. And the big warning here is the variance in value is pretty wide. For those of you who don't know what beta is, it's basically the risk attributed to the market. So with a beta of 3, if the market goes up 10%, the company will go up 30%. But if the market goes down 10%, the company will go down 30%. Lastly, we have a terminal multiple of 8 times last 12 months revenue. This is based on the all-time low that was achieved 4Q22, 1Q23. So this is super conservative. We're going to see this next in the DCF valuation, so pay close attention. So what's the takeaway? Conservative assumptions equals conservative results. Let's hop in the model. Okay, forecast drivers, as I mentioned, very high revenue growth. We chose the midpoint of management guidance. Research and development, they have to be very careful here. We have it growing at a 20% rate. Right now, it outpaces revenues. Also, general administrative, basically what they're paying their employees, that's been growing at a decent clip, 10%. The interest rate on debt, 14.25. We don't have to worry about that because they have no debt. Okay, DCF assumptions. Real key thing that we have to focus on here, a beta of 3. This is a massive, massive beta. But the good news is by having such a high beta, we're going to have a very high cost of equity, which is going to lead to a high weighted average cost of capital. So we're doing a very, very conservative valuation here. Another thing to note, I had to adjust the shares for the preferred that got converted. So this doesn't match what you're going to see on Yahoo Finance, Bloomberg, etc. You need to make these adjustments. That's what professionals do. That's what we do on Wall Street. Lastly, very important, the bulk of the value in any DCF model is going to be the terminal value. That's the value from the end of the model out into infinity. So when we look at the terminal multiple, it's very important that we understand this. Normally, we'd like to do it off of EBITDA, but the company has negative EBITDA, so we have no precedence. Also, there's no comps for this company. It's a company of 1. So what we did was we looked at last 12 months revenue multiples, 9-quarter averages from 2Q22 to 2Q24, excluding the highs and lows. This gave us an average of 24x, a low of 15x, and a close of 23x. So I would have been fully justified using any one of these, including the 15. But what I did was I went with the all-time low of 8 times. So this is being super conservative between the 3 times beta and the 8 times multiple on the terminal revenue. All right, next, DCF valuation. We ran 3 scenarios, a bear, base, and bull with the current model at base. So future cash flows are discounted back to today. That gives us TEV, or total enterprise value. We strip out net debt to get to equity value. High revenue growth, lots of cash, 180 million, and upside potential. But is SoundHound worth buying today? Remember, the stock is up 95% year to date. Wall Street has SoundHound at a median of $7. That's a 69% discount. But what does our analysis show? Let's hop in the model. Okay, everybody, DCF time, the moment we've all been waiting for. So EBITDA, as you can see, doesn't turn positive until 2028. We strip out DNA, we get to EBIT. We strip out cash taxes, we get to EBIT. We add back DNA, we take into account operating working capital. We strip out CapEx, we get to free cash flow to the firm, which again doesn't turn positive until 2027. Ultimately, the bulk of the value is captured in that terminal value. So this is 8 times the revenue of 2028. We end up taking those cash flows to discount. We multiply them by the discount factors. This gives us the present value of those cash flows. That leads us to total enterprise value. We subtract the debt. We add the cash. We subtract the non-controlling interest, we add associate investments. That gives us an intrinsic equity value of about $1.7 billion. We take the shares outstanding, we get an implied share price of $5.10 compared to the close of $4.14. That gives us a 23.1% discount, which is a buy. On Wall Street, if it's greater than 20% discount, it's a buy. 0 to 20% discount, it's a hold. And if it's at a premium, we don't want to own something that's overvalued, it's a sell. Okay, sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth versus CapEx intensity and weighted average cost of capital versus the terminal multiple. So what did we find? 10 out of 50 or 20% showed a sell rating. 10 out of 50 or 20% showed a hold rating. 30 out of 50 or 60% showed a buy rating. Now, we also ran each of these three scenarios equally weighted, got a weighted average value of $5.43, which is a 31% discount. So what's the takeaway? Utilizing conservative assumptions, we show a buy rating for the stock at a significant discount. Let's hop in the model. All right, sensitivity analysis, as I mentioned, we end up showing a sell in the lowest revenue growth scenario. We end up showing a buy in basically the vast majority of the scenarios. And ultimately, we have a majority buy relative to sell or hold. But one thing I want you to really focus on is the gap, the variance. So we have anywhere from a 14-15% premium all the way to a 70+% discount. All right, next we move into the scenario analysis. We equally weight each of the scenarios, bear case, base case, and bull case. We effectively have going down to $3 all the way up to $8. We do a weighted average. What do we get? $5.33. It comes to about a 29% discount, which is a buy rating. Okay, the wrap up. So Wall Street has SoundHound at a median of $7 with a high of $9.50, which is a 129% discount, and a low of $5, which is still a 21% discount. The stock has shown massive volatility with a beta of 3, increasing 4.2x in the first 3.5 months of 2024, going to $8.91, only to lose 54% since. Despite that, the stock is still up 95% year to date. Now, you should seek the advice of an investment professional always. I do not have a position in SoundHound, but it is a very interesting AI investment opportunity. I honestly look at this from a financial perspective, similar to Tesla in 2015, 2016. The financials were simply too scary to invest. But if you believed in Elon Musk, his vision, and rolled the dice, you were compensated quite handsomely. Insiders at SoundHound own 11.5% of shares. Elon Musk owns 13%, so it is similar, but management hasn't been buying the shares, as we talked about earlier, which is a bit of a red flag. From down 30% to $3 in the bear case, or up 90% to $8 in the bull case, the upside outweighs the downside by 3x. This is a very exciting, though volatile company with a market-leading position in a niche space of AI voice technology with 160 billion market potential. With NVIDIA as a partner and investor and some of the world's largest and most well-known brands as customers, I'm excited to see the future of SoundHound over the next few years and beyond. If you like this and want to see another juicy stock valuation, check out my SoFi model right here. And if you found this valuable, please share this with someone who you think would enjoy this. And as always, be relentless.